Hello and welcome to the FITT Show, the show that is geared toward giving you tips, strategies, and methods and techniques on how to manage your money, hoping that you will be able to generate and create wealth, and not only just wealth, but generational wealth. Good evening. My name is Bobby Kinzer, and that's Thomas Doty, my good partner. And we're here tonight like every Thursday, to drop some knowledge. And this week, we're going to be talking about what you should know about taxes. Now, this is a big one because I know for a lot of people, it's a very big subject. And why don't you talk a little bit more about taxes, Doe?
Yeah, crazy story. Once I became certified, I decided to do my mother's taxes. And it happened to be the year that she retired, and she didn't have any money withheld out of her retirement check. And so I do her taxes, and she ends up owing some money. So I go to her and say, you have to pay Uncle Sam a few $100. And my mother, who loves me dearly, looked at me, and she told me when H&R Block did her taxes, she never had to pay. She said, I must have done something wrong. Go back and look at it. And I knew exactly what the problem was. She didn't have any money withheld. And I didn't want to get into a long explanation about withholdings and W-4s. So I went back, paid her tax bill myself, and told her, oh, yeah, I made a mistake. Everything is fine. Immediately changed her W-4 to make sure she got a refund every year. But
what a good son.
Yeah, and I say that to try to explain how difficult the tax situations can be. It can be very complicated. Every situation is different. And there's a lot of things that change pretty often. There's a lot of things that you need to know. And if you don't know, you should have someone who does know and understand, who stays up to date. Because the last thing you want is to not do that correctly and get crossways with the IRS, because they will come get you.
Yeah. So taxes it could be a very complicated subject, or it could be a very simple subject. You know what I'm saying? So it could go either way. But we got a lot of information today. We hope you make sure you go out there and click on the thumbs up button, the like button, to like us so they can get some traction. Make sure you click on the heart and, put some comments out there. Let us know where you are, where you're coming from, or that you're out there with us. Or if you have a question, please put it in the comment box and we will definitely answer that question. So, Doe, how does the tax code contribute to the wealth gap?
Well, it contributes directly because there's so many instances where if you have money or are wealthy, you have tax advantages that the average person cannot get to. And I'll name a few of them. The first is obviously home ownership. If you own a home, the tax code basically subsidizes that purchase with you can deduct your mortgage interest, you can deduct your property taxes, and you can use both of those things to lower your tax bill. Capital gains. If you are invested in stocks and you sell a stock at a gain, the capital gain tax allows you to lower your tax bill. Another is the gift tax. If you're wealthy, you can give your kids, each spouse can give their kid up to $15,000 a year, or a couple can give 30 to a kid with no tax implications. Inheritance taxes. You can pass money along in generations. With inheritance tax, again, there's a limit, but the limit is very high as to how much before taxes actually kick in. Another is the FICA, Social Security tax. And that one's a little tricky, and most people probably don't recognize it. But if you are a high earner, if you make over $142,000 in a year, the first part, let me back up a little bit. There's two parts to Social Security tax. There's the FICA part and there's the Medicare part. The FICA part is 6.2. That's what I'm referring to. There's a limit on how much you pay. So if you make 140, I think it's 142,000, once you pass that, you don't pay that 6.2% anymore. And to give you an simple example, so if I made 280,000, I would only pay an effective rate of 3.1% in FICA. But if you make less than 142, you pay the full 6.2%. So somebody who makes double would only pay half of the FICA tax, if that makes any sense. So if you make 75,000, every penny you make, you pay 6.2%. If you make over 142, you don't have to pay that anymore. That's an advantage to being wealthy. Another is the retirement accounts. A lot of people who aren't wealthy sometimes don't have jobs that even offer retirement accounts, and they're used a great deal by the rich to put money away and to avoid taxes. And last but not least, it's the actual single versus married tax rate. And I didn't know this, but the marriage rate for Black folks is a lot lower than it is for white folks. So it's if you're married and only one spouse works, you are advantaged, because if you compare that to a couple working, they're paying childcare expenses. If their children involved, they're both paying commuting expenses, where the person who's married and only one spouse works gets to lower his taxes by having two people as opposed to one. So all those things contribute to the rich get richer and the poor can never catch up. So it's purely economic advantages to being wealthy in this country. And that's how the tax code is written. And I guess since most rich people actually do the tax code, that's pretty much how it works. If you look at this chart, it shows the housing wealth at age 60. Let's just say age 60. And you can see the differences for whites and blacks. It's for a lot of reasons. We Black people are don't own homes, and mostly it's because of poverty. And that's the first step in building wealth, is having a home. There's so many other things, which we'll get into a little bit later, but we'll talk about why home ownership is so important. But those things all lead to a big increase in the wealth gap. And they're all in the tax code. And what we want to talk about is how you can maximize or minimize your taxes and keep more wealth in your pocket.
Yeah, also what this chart is showing, though, it's like saying a person is at age 60 or 61. And if you look at the graphs, it's saying at age of buying the house, first home, it's showing that if you waited longer to buy a home, it's even less value. Because if you look at younger under 35, you're saying that 60-year-old person purchased it when he was under 35. It actually accumulated way more wealth than if he waited till after 45 and purchased a home. It's a big difference, man. I mean,
yeah, and it's crazy. I bought my first house when I was 25, and with my job, I was relocated 9 different times, buying and selling a house each time. And over those 9 houses, I earned about $480,000, all tax-free, just from owning a home and the value of the home going up. So that's how important that is as far as building wealth. It's a good building block to have a home.
Yes, it is, and you get so many tax benefits from doing that. And just talking about the wealth gap, though, I want to show a quick chart, man, that kind of sums up this disparity and wide gap between wealth. This is done by the Urban Brookings Policy Center, showing that the average savings from the tax cuts from the 2017 tax reform by Donald Trump, people making under $25,000, they really only save $60. People making between $48,600 or $86,000, 100 is about a $930 savings. But look at the top 1% earners. They really made out with these tax changes of $51,000. I just think that so, once again, shows the disparity in the wealth gap between the haves and the have-mores. I like we talked about, man, why do people fear taxes so much? I know people, they not just tax, they fear the IRS. A lot of people fear the IRS more than they fear the FBI or the CIA. I know people who get mail from the IRS and won't open it, afraid to open the mail. But one of the keys about the IRS, man, you have to face them. You put them off, you're going to have troubles. And actually, the IRS, remember this, people out there, there's a lot of scams out there, tax scams. The IRS will not be calling you. The IRS sends you mail. And they actually be sending you mail, and it's really asking how can they help you for the situation that you got yourself into. But most people get the hands get sweating, palmy, nervous. But the IRS is going to send you, once you be having some issues, they're going to send you some information, say, hey, what's going on? What can we do to rectify this situation? So stop being afraid of the IRS. And one of the main things about taxes, you all, and the tax code, you must understand. You cannot err on the side of that you don't want to understand. And if you don't understand it personally, at least hire a professional tax advisor that knows about the taxes, because you can't be messing around, playing around with taxes. Another interesting thing about taxes, right? Getting that big refund check, it really isn't a big refund, because if you're getting a refund at the end of the year, that means that Uncle Sam has been using your money interest-free, and it's interest that you could have been gaining if you'd have had that money yourself to invest. And we're going to talk about that a little bit down the road here, about the benefits of, the right tax exemptions and the balance and the blend that you must have to actually make sure you have the proper tax strategy. We will get into that. Though we got a Mary Kay Null, who's Nell, is it Nell or Null? Nell. Yeah. Question, and we'll get to it. See, her question is regarding capital gains tax. So the taxes that I pay on my capital gains this year are counted against taxes owed next year.
Yeah, we'll get to capital gains in 1 minute. Let's make sure we come back.
That's what I wanted to say. Yeah, we're going to get to you, Murray, so stay tuned. Capital gains is a big one on our list, and we're going to be coming up talking about that very soon. So, the one other one I want to talk about is, one of the best ways to beat taxes is to make more money. So many people are afraid to make more money because they say they're going to increase their tax. But the thing is, Uncle Sam cannot take more taxes than is allowed. So if you're in the 24% tax bracket, give Uncle Sam his 24 and pocket your 76. So make more money. But some people, I don't want to make no more money. I'm going to be taxed more. If you're being taxed, though, what does that mean?
It means you're making money. That's what
it means. You're making money. So stop being afraid to make more money. Just make sure you have the proper tax planning so that you can, like Dope said early on, it's about minimizing the amount that you have to pay Uncle Sam, and that's Aunt State. Don't forget about Aunt State. And putting as much as you can in your own pocket. Okay? So with that, Dope, let's get into the tax system. Okay? Now, let me tell you, the tax system is it's a very interesting system. But I wanted to talk about the standard deductions first, right? Standard deductions versus itemized deduction. Now, the IRS lets you take standard deductions on a no question asked basis. That's the beautiful thing about standard deductions. They don't want to ask you no questions. And some of you out there who are skipping and tipping in the dark, doing all that hustling stuff, you might want to consider taking the standard deduction because they don't ask any questions. But the only thing with taking standard deductions, you do not get you can't deduct like home mortgage, medical expenses, and charitable donations and things like that. Dope's going to get into talking about that on itemized deductions. But that's the downside of taking standard deductions. Now, before the tax reform of 2017, the tax law, about 2/3 of the people, of 2/3 of tax-paying Americans was taking advantage of the standard deductions. But since the 2007 tax reform that Trump had, over 90% of the people are taking the standard deductions. And that's because the standard deductions has increased. And we have a chart here to share with you on that. So in the 2021 tax year, if you're single, the tax deduction is basically doubled. And now it's $12,550 from the previous, before the tax reform. And for married filing jointly, it's $25,100 for the tax year 2021. As you can see, 2020, it was $12,400 and $24,800. But for tax year 2021, if you already filed 2020, it's going to be $12,550 single standard deduction and $25,100 for married filing jointly.
So
yes.
And seniors get a little bit more than that. There's a little extra kicker, about $1,300 for seniors, in addition to the $25,100 if you're married.
And it's a very good point, because the seniors are 65. And by the way, blind people or visually impaired, no, they say blind, is around additional $1,700. If you marry, it's additional $1,350.
Right.
If you're 65 or older. And now this, believe it or not, though, these standard deductions, man, has really hurt like churches and nonprofit donations, because now, you have these high, standard deductions. A lot of people into churches, they don't have to be trying to get these extra write-offs by donating to the church. So a lot of churches have been suffering from this new tax law, because you get a whole standard deduction of $24,000 if you're married, and it's been putting some pressure on them. And this is what people don't know, though. This tax law expires on personal taxes at the end of 2025. This ain't a permanent tax change. So talk a little bit about itemized deductions, though.
Yeah, itemized deductions. If you have more individual things, and some of those include mortgage interest, property taxes, or no, state and local taxes is a separate issue. And a lot of the itemized deductions are now capped. When I say that, for example, state and local taxes, you only can itemize up to $10,000. Employee non-reimbursed business expenses, casualty losses, all of those things would be part of your itemized deductions. And if they are greater than the standard deduction, then that's what you should itemize. And the important thing there is you have to keep good records. And as Bobby mentioned, the contributions is another big part of itemized deductions. And I'm hoping people don't give based on the tax deduction. I'm hoping they give out of the goodness of their heart. But I'm sure at the end of the year,
right,
trying to drop a tax bracket or something. But all those items, I think I mentioned casualty losses, all those items they have parameters. For example, you can deduct medical and dental expenses that you didn't have reimbursed, but it has to be 7.5% over your AGI, more than 7.5% of your AGI, which is your adjusted gross income. And that's basically all your income minus a very few deductions. But if you're going to do itemized deductions, make sure you keep very good records. And so if you do get the IRS knocking on your door, you'll have proof of what you've done. So those are some of the items that make up itemized. And again, they all have parameters as to how much you can actually claim.
And so the thing is, if you're in a situation, one of the approaches is to actually look at both ways of calculating your taxes. If you're a person that may feel you have a lot of itemized expenses, then you might want to run your taxes both ways, with the standard deductions and itemizing, because if your itemized deductions are higher than your standard deductions, you can save some money. But if your standard deductions are lower than your itemized deduction, you may save some time.
Right, and I'm a big proponent. I use TurboTax myself because it's much too complicated to try to do by hand. And up to certain income levels, TurboTax is actually free. So at least take a look at that, and it will make those determinations for you. It will walk you through all the possible things that you could have as an itemized deduction. It'll handle the caps on those items, and it will advise you as to which standard deduction or itemized deduction is more beneficial for your particular situation. And all the tax packages are pretty much the same. They're all pretty thorough and do a pretty good job of getting your taxes done.
I'm glad you brought that up too, though, because these particular software, tax preparation softwares, nowadays, especially the ones like, did you say Quickens?
I use TurboTax, yeah.
TurboTax. That's what I think about TurboTax. I meant to say. The great thing about that, you put the information in, and it tells you. You can ask the question. I had this, expense. It'll bring up the form for you. It's automated, or it will answer the question. Or if you put in the wrong information, it will let you know in some of the fields. So that's the beauty of using these automated software, tax software. Though a little bit about exemptions and withholdings, because that got a lot of people when the Trump tax change and the tax brackets changed, and they were able to get more money, but the people didn't change their exemptions, and they ended up either getting less money than they thought they were going to get back, or they ended up owing. They're like, what the world happened? Can you explain a little bit how that?
Yeah, it used to be more straightforward when you had your filing status, married or single, and your number of exemptions, which was typically the number of people in your household. You put in that you're married, you put in how many kids you have, and it would estimate what your withholding should be. But we don't have personal exemptions anymore. We just have the standard deduction. And there are other items that the exemptions don't take into account. For example, if you contribute to an IRA, or if you have any other tax credits, like child care credit or college credit, or any of those types of things, or if you have a large number of itemized deductions. So it doesn't take those things into account. Whenever you started at your job, you had to fill out a W-4, and that basically says your filing status, and it estimates how much you should have withheld. And then you can actually increase that amount by the amount you're having withheld by, if you're married, claiming single, in which case you'll withhold more, or you can have less withheld by adding more exemptions. Every exemption you add is about $2,000 of AGI that it will reduce. And so, as Bob mentioned before, as far as doing planning, it's much easier. Just start with where you are now, get your taxes from last year, see where you ended up, If you ended up about even, then obviously your withholdings are okay. If you got a big refund, you don't want to get a big refund. You want to use that money during the year. And I know some people like the idea of getting that big check and doing something special with it at the end of the year. But as we always talk about, that's money that you could have invested in something and working for you. So you take a look, and if you're under withheld, you need to increase the amount of money you're having withheld by adding an additional amount. So you put in your filing status, you put in your number of exemptions, you can actually put in a fixed dollar amount. And the key thing here, you don't want to end up owing the IRS. There's a couple of different situations where you can end up owing. And as long as you have withheld 90% of your current year tax bill, or you have withheld at least as much as you had withheld the previous year, you will not have to pay an under withholding penalty. And trust me, if you can avoid those little letters from the IRS saying you under withheld, you definitely want to do that. Plus, you don't want to get that giant bill at the end of the year. Me personally, I always try to make sure I owe a little bit at the end of the year. I'd rather have to pay them than them having to pay me. But take a look. Take a look at your last year's tax form. Look at your withholdings. See if you need to make an adjustment. And if you do, you grab a W-4 form and adjust your withholdings so they end up where you'd like to be.
And right quick though, just want to talk about a deduction versus a tax credit.
Okay.
Right, and it's plain and simple. A deduction actually lower your adjustable tax income.
Adjusted gross income, AGI. Yes.
Yeah, your AGI, your adjusted gross income.
Right.
Tax credit is after all of those things happen. It's over your actual whole tax amount, the tax credit.
Right. So that direct credit to your things like the child care credit. That's a direct reduction in your taxes versus an itemized deduction. And another way to look at it, if you have $1,000 worth of itemized deductions and you're in a 24% tax bracket, that basically saves you $240. Well, $1,000 tax credit reduces your tax bill by $1,000.
And though we need to reiterate that point, because most people think that when they see these tax breaks or tax savings, that they sometimes a dollar for dollar, like even your interest on your home. But it isn't. It's basically the amount of your tax bracket that you're saving. So if you're in a 24% tax bracket, right? You're saving 24 cents on the dollar. It's not a dollar.
Exactly.
On every dollar. You're not getting the full dollar write-off.
Correct.
That's something that people need to understand. Your mortgage is not a dollar for dollar write-off. Because that's a deduction. Once again, that's a deduction. But a credit is a full dollar for dollar reduction. Just want to make that right quick. Yeah, AGI, adjusted gross income. Okay, Doug, we want to talk about the marginal tax rate, right? Which is the rate total is the tax rate on the last dollar you make. So a lot of people get this confused quite a bit, though. The marginal tax rate versus the effective tax rate. And we're going to talk about that real quick, okay? Now, your marginal tax rate, like I said, is the tax rate on the last dollar you make. So let's say you made $100,000. That was your salary for the year. If you look at the tax break and you're single, look at the column, the rate for singles with taxable income over $86,000, $375, you will fall in the 24% tax bracket. But that is after your deductions and other write-offs, what that particular amount is, and if it falls, let's say it's like $90,000 after your deductions, then you are in the marginal rate is 24%. but we live
So
on the
the
tax.
marginal rate would be, Bob, the marginal rate would be 32 if it's over 86.
Why do I do that every time though? It's
Right.
32. Sorry,
If it's over
32
86,000.
because it's over 86. It's
Correct.
86,375 up to 164,924. So it's 32% is your marginal. But what people don't realize, that's when it's the marginal rate. But the actual tax tables are set up as a progressive process. So really, it's not all your money is not taxed at 32%. So let's go under the $100,000 that you made, right? That is taxable amount, right? What happens is up to the first $9,950 is taxed at 12%. The difference between $9,950 and $40,525, that is then taxed at 22%. The difference between $40,525 and $86,375, that difference, that amount between those two amounts will be taxed at 24%. And then the remainder, the 86,000 up to your 100,000, or your 100,000, you fall in that, is going to be taxed at 32%. And Doe, what was that? Actually, that's your your marginal rate, your progressive tax rate is that amount. But when you take the amounts that I just told you, how you tax at the 12%, the 22, the 24, that then becomes your effective tax rate, which is, I know you've heard that you have the marginal tax rate, which is this table. Then you have the effective tax rate, which is the blended total from each of these brackets. And if you add that amount that way, your actual effective tax rate will be 23%, and your marginal rate, which is the last dollar amount that you make that is taxed, will be 32%. Now, I hope I didn't make that too complicated. Do you need to clear anything up, clarify?
No, you did a good job on that. And that's the point you made, that it's progressive. The more you make, the higher tax rate is, up to 37%. And that effective tax rate is what most people get confused with the marginal tax rate. The marginal tax rate is that last dollar you make, the tax you pay on an extra dollar of income.
Right. So I hope we cleared that up, because a lot of people don't realize that progressive tax. They think the full amount is being taxed at whatever that marginal tax rate is. And we want to make sure you understand the difference. Okay, Doe, let's move on, man, to a category called taxable, tax-free, and tax-deferred. Let's get into that right quick.
Yeah, and then if you think about income, all the different types of income, there's three things that could happen to it. It can be taxable as ordinary income. It could be tax-free. It could be tax-deferred. Those are the three things that we're going to talk about. When you think about things that are taxable, it's usually just ordinary income, your wages, your interest, your dividends to a certain extent. When you think about tax-free, that's usually municipal bonds that may have tax-free interest. Finally, you have tax-deferred, and the most common are your IRAs and your Roth IRAs and 401ks. Now, make sure you understand the distinction there is some of those contributions are before tax, which means you don't pay tax on it. And some of those are after tax, which means you take the dollars after they've been taxed. But in both cases of IRAs and 401ks and Roth IRAs, the earnings grow tax-free. You make sure you understand that. Okay, so you have that. Those are the different ways money can be taxed, or not taxed, or deferred. And you need to be clear on that. And if you are in a higher tax bracket and you have extra money to save, it behooves you to lower your tax bill with before tax savings, and to let your money grow tax-free put away for the long term, to have a lot of money for whether it's for to pay for college or to retire or whatever. But it's always good to have money growing and not having to pay taxes on it.
And that is very important. So those are the categories, you all. So make sure you know, because it's no way around it. It's either taxable, tax-free, or tax-deferred. No other choices. You're in one of those boxes. And the key to tax planning is making sure that you move into those different boxes. And especially when it comes to retirement planning, it's all about tax planning and making sure you move into the least amount that you would have to pay in taxes. So talking about that though, what are some of the advantage of how can some people take advantage of the tax system?
Well, the first thing, a lot of people have their money in like passbook savings account, in which you pay the interest on that as ordinary income. So that would be, you'd pay that at your marginal tax rate, which is your highest tax rate. But let's say you do a couple of things that help you tax-wise. If you own stock and you receive dividends, well, qualified dividends are taxed at a maximum rate of 20%. So even if you're in the 24% tax bracket or the 32% tax bracket, if you have qualified dividends, and there's a definition of those, and it's basically most American companies. But if you have qualified dividends, the highest rate you will pay is 20%. Now, obviously, if your tax rate is 12%, you'd pay 12%. But most people get into that 22, 24, 32, 37 category. So qualified dividends, you can lower your tax bill there. Another one is capital gains. And again, that's another one that varies depending on your income. You can pay 0% taxes, 15% taxes, or a max of 20% taxes on capital gains. Again, if you're in the 24, 32, 37% tax bracket, the highest tax you will pay on a capital gain is 20%. So it behooves you to invest in something. Hopefully it grows, and you can have a maximum tax rate on those gains of 20%. Now, let's say you invest and you lose. You can take capital losses to reduce your capital gains. Okay, so let's say you have $5,000 in gains, you have $5,000 in losses, your tax on the capital gains will be 0. But if you have 5,000 in gains and let's say 7,000 in losses, you can actually reduce your taxes with a $2,000 capital loss. But the max on capital losses is $3,000. So if you have
per year,
$3,000 per year. So if you have a net capital loss of $5,000, the most you can claim this year is $3,000, but the $2,000 excess carries over into next year's taxes. So you don't lose that extra $2,000. You just have to move it forward to the next year. So again, it says invest in the market.
Don't hold right there, right quick.
Hold
there, right quick. We want to answer Murray K. Nell question, and it is regarding the capital gains taxes. So the taxes that I pay on my capital gains this year are counted against taxes owed for next year.
No, this year's capital gains will be in 2021's tax return. So it's current year. It's current year.
Right. So I guess maybe she's looking at this as, the tax year ends on April 15th of next year. I guess she's thinking that. I hope that's not what she's thinking, because it applies to this year.
Right.
And capital gains, if you acquired those capital gains within this year, you pay taxes on it within the year that you acquired the capital gains. And though that brings me to the issue of
one point I missed is
And
short
that's where I
term
was
versus
ready to
long
go.
term. Okay,
That's where I was
yeah,
ready to
short
go.
term versus long term. If you buy something, an appreciating asset, a stock, Bitcoin, and it appreciates. If you sell that item within a year, 1 year or less, that gain is counted as ordinary income. And so you don't get the capital gains tax on anything that's 1 year or less. Yeah.
Zero.
It's all ordinary income. But if you hold any appreciating asset over 1 year, you get the benefit of those lower capital gains tax. And the other item I didn't want to forget is, I think I mentioned it before at the beginning, is sale of your home. You get to claim up to $500,000 on the sale of a home without having to pay taxes on it. And so that's another benefit or another way to minimize your tax bill. Any gains on your house reduces your tax, doesn't increase your tax bill.
Right. And that's important to know. So what is the lesson here? My good friends, long-term capital gains is the way to go. Holding stocks, bonds, securities, should I just say. It's better for the long term because a lot of people be jumping in and out. And what does that do, though? Not only do sometimes you shortchange yourself on the earnings of it growing, but you also create these tax implications every time you jump in and jump out and sell. And what did we just say? And if it's doing it on a short term, those are hitting you, your ordinary income, you being taxed at the rate, the top of the rate.
Yeah.
You're being taxed at the marginal rate. So that's even more the strategy of going long term, because as we always say on this show, we like for you to invest in the stock market, but make sure you know what you're doing or having a financial advisor to help you. The same thing with taxes. You need to, if you don't understand it, get a tax advisor to help you, because we're not trying to tell you, because we know everybody's personal tax situation is unique to them. And so we're not trying to tell you what to do specifically with your taxes, but we want you to understand the basic understanding of the tax code so that you can make it work for you and you can enter into the financial mainstream, because there's other individuals that has been taking advantage of the tax code for centuries. Not days, not years, not decades, for centuries. Those who know earn, and those who not pay.
Right.
So with that,
those are the rules. Those are the rules of the game. And so once you accept that, what you can do is try to take advantage of the rules that everybody else, as Bob said, has been doing for centuries. But those are the rules.
There's no rocket scientist to this. There's no mojo. There's no boogeyman out to get you. Another thing I want to share with people is taxpayeradvocate.irs. That's what I meant to put in the banner. Taxpayeradvocate.irs.gov. This is the place that you can go on that website and get a number for your region, because taxes are regional, just like the Federal Reserve Boards have 12 different regions for Federal Reserve banks. Same thing with the taxes for particular states, but the federal is all the same. But taxpayeradvocate.irs.gov, they will help you in any tax situation. As people are afraid, oh, Bob, I ain't gonna go there, they might find out. No. Stop being spooked. The only way they can help you if you be straight up and be straightforward. And taxpayeradvocate.irs.gov is really, it's funded by the IRS, but they look actually independent of the IRS. They're really trying to help you. They actually are attorneys that you get free of charge. And I've sent people there and they have been relieved of very major tax burdens. So keep that in mind. So dope, man. Let's go ahead and take this on home. Let's talk about the takeaways from what we talked about tonight, because this has been Once again, a wealth of information. And we know we went through a lot, everybody, and we just want to do a recap to let you know some of the takeaways that we have. And one of the first ones is there's no substitute for understanding the tax code or having a professional tax advisor working for you. We cannot stress this enough, you all, because once you get those taxes straight, the federal taxes, once you get them straight, it really flows straight into your state taxes. So this becomes well easier if you plan your taxes.
Yeah. And to reiterate, have a plan. Figure out the best strategy for your situation. Get your W-4, which is your withholding, straight, and make sure you're not getting that giant refund at the end of the year and celebrating somebody giving you back your own money.
Your own money. Third, remember, each state and local municipality is different. So you must make sure you understand what the state and local tax implications are upon your taxes.
Take advantage of the tax code. Buying a house, investing in the stock market, buying appreciating assets. And then you can get some of the advantage that the rich folks have been getting for years.
And next note?
It's a moving target. This isn't a simple process. The tax laws change pretty often, sometimes in major ways, as they did in 2017, sometimes in more subtle ways, but you have to stay on it. You have to have somebody who's abreast of what's going on.
And lastly, but not least, receiving that big refund at the end of the year makes no sense at all, you all. It's all about balancing your taxes, what you owe Uncle Sam, and what you keep in your pocket. Remember, it's not how much you make, it's how much you keep. And then when we talk about our other subjects like investing, it's not what you make about what you keep, but it's also about what you do with what you keep. Because you don't want to be working for your money, you want your money working for you. So dope. I just want to share Rob Robson out there, our frat brother. What's up, Rob? He said we get free tax preparation through AARP. I didn't know that. And make sure who you go to, you all, to get your tax preparation. I know we got all these different ones. It's not even Hewitt now. Hewitt Tax and
H&R Block.
H&R Block and all these other tax. But be sure you look up before you go to the people to prepare your taxes, because sometimes it's a lot of fluff. And they be giving you like they're doing a whole bunch of mojo because they know you don't know. And next thing you know, you're getting charged these big fees. And a lot of times they just plug it into a daggone software and just churning it out. But do seek professional tax help, you all. We can't stress that enough. And learn yourself too. We always talk about this. I'm gonna end on this though. We always talk about this. Learn. You need to understand your own financial situation. You don't have to go to school, get no finance degree. We ain't have to get no certifications, but there's enough information out there for you so that you know and understand your financial situations. And then you can talk to whoever it is about your situation, and they can give you more clear direction. Doe, anything you'd like to add before we end tonight?
Only thing I'll add is those tax packages can be a little tricky too, because they're advertised as free, right, but they do everything they can to make you buy the upgraded version. So you have to know what you're doing to know which version you need to buy. So again, just get on it, take some time, understand it, and if you don't, find somebody that can help you.
Great, Dope. Once again, another show just packed with just a whole lot of information. We really hope that helped you out there. If you have questions, you can continue to put them in the comment box, because we do receive those even after the show is over. You can continue to put those questions out there, and I or Dope will respond to any questions that you have. Once again, we're here every Thursday, 8 p.m. Eastern Daylight Time. the FITT Show. Financial information for today and tomorrow. Thank you, my partner, as always, my frat brother. Great job, Dope. We love you all, and we just doing this because we want to see you build wealth. Peace be with you. Black Lives Matter. But Black Lives Matter to have wealth matters even more.